Hi guys, welcome to the A Plus Trading channel. In today's video, we'll be covering the basics of what is Forex, who trades Forex, and understanding the currency pairs. Without further ado, let's get started. The first question you might be asking is, what is Forex? Now, Forex trading or foreign exchange trading is the buying and selling of foreign currencies to make a profit. Now, similarly, where you have market where buyers and sellers interact to purchase goods and services, it's the same with the forex market. However, you're buying and selling currencies and not goods and services, and this is all done with the aim of making profit. Trading forex requires the trader to anticipate the strength of foreign currencies when pitted against one another. So when trading forex, what you're basically doing is comparing the value of one currency to another. Is this currency stronger than this currency at that particular moment in time? Is this currency going to be weaker than this currency at this particular moment in time? And we use what we call fundamental analysis, technical analysis, and some other analysis to determine these factors. Now, the next question you might ask yourself is, who trades Forex and why do people even trade Forex in the first place? Now, Forex is traded amongst large institutions such as banks, hedge funds, and commercial companies. You also have small retail traders in the market, such as people like me and you who trade Forex through a regulated broker. Now, we all trade Forex as previously stated with the aim of profiting, and we do this through the fluctuations of the currency's prices. So as said before, we anticipate the strength of one currency against the other or vice versa. Now, how does the Forex market work? Now, when you place a trade, you're expecting a rise in one currency against the next, or consequently a depreciation in price of one against the next. So like for example, we have this currency pair here, Euro USD. So for example, you purchase a buy or you place a buy trade on the Euro dollars or the Euro USD pair. Now what you're doing is that you're expecting appreciation in value of the Euro dollar against US dollar. And if you had placed a sell, then you're expecting the opposite to happen, which is the Euro dollar to depreciate and the US dollar to appreciate. Now, the difference in movement between these appreciation or depreciation would be referred to as your pips, and this is where you would make your profit from. So for example, you buy the USD at $12 and then the Euro USD appreciates to $14. Now the difference between 12 and 14 would be 2. So that difference in price movement from 12 to 14 would be 2, and that would basically be your pips. So it moved 2 points up. So that would be your difference in price movement because it moved from 12 to 14, which is a 2-point move. Okay, now you might be hearing me using the term pairs, so you might be wondering to yourself, what are these pairs? Now, currency pairs is the value of one currency being quoted against the other. So the first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. So here we have GBP USD. So the GBP represents the Great British Pound and the USD represent the US dollars. So first, in the first currency is our base currency, as you can see here. Then normally it is followed by a slash to separate the base currency from the quote currency. Then after the slash would be your quote currency. Then we have our price here. So what this is basically saying to us here is that you would need $1.32 US dollars to purchase 1 British pound. And we can also say it this way, that 1 British pound is equivalent to $1.32 US dollars. So here it's saying that the currency compares the value of one currency to another, the base currency versus the second or the quote currency. It indicates how much of the quote currency is needed to purchase 1 unit of the base currency. So currency pairs can be divided into two categories. We have our major currency pairs and our minor currency pairs. So our major currency pairs here would be our Euro versus US dollars, our GBP, which is our Great British Pound versus US dollar. We have US dollar versus Swiss franc. We have US dollar versus the Japanese yen, US dollar versus the CAD, AUD versus US dollars, and New Zealand dollar versus US dollars. Now, the pattern that we can observe in our major currency pairs is that they all contain the US dollars, whether as the base currency or as the code currency. Now, the reason for this is that the US dollar is the national reserve currency of the world. So 85% of the transactions that is settled in the world are settled in US dollars. For example, you're in Jamaica and they use Jamaican dollars. Now, to the world, the Jamaican dollar isn't worth anything. So, what the Jamaican government would have to do is that they would have to buy US dollars to purchase goods and services outside of the country, as countries would only take a currency that is of value that they can also use to buy other goods and services outside of their country. Now, our minor currency pairs would be Euro versus your GBP, GBP versus JPY, GBP versus Swiss franc, GBP versus AUD, Euro versus JPY, AUD versus the CAD. And these three-letter words is basically abbreviations for the currency pair. So our GBP is our British pound, JPY represents Japanese yen, CHF Swiss franc, AUD Australian dollars, and CAD Canadian dollars. Alright, and as you can see, these minor currency pairs, they do not contain US dollars, right? And you might ask yourself, like, what's the difference between the major and minor currency pairs? Now, the major currency pairs, they trade quite frequently, quite often. They're more liquid and more volatile. So what you'd find out is that most traders would trade the major currency pairs over the minor currency pairs, as there are more opportunity for good price movements in a short space of time. It's liquid, you can enter trade and out within minutes, seconds, lower spread, and so forth. So most traders would opt to the major currency pairs instead of the minor currency pairs. That doesn't mean that they do not trade them, though they are still traded, but not as much as the major currency pairs. Now, we're going to be explaining what is a pip. Now, pip is the percentage in point. It's a tool of measurement related to the smallest price movement made by an exchange rate. Currencies are usually quoted to 4 decimal places, meaning that the smallest change in a currency pair would be in the last digit. So here on our left hand side, we have the euro versus the US dollars, and we see a price of 1.1051. Now, as stated in the definition, our pip is quoted in the 4th decimal place. So this would be our 1st decimal place, this would be 2nd, this would be 3rd, and this would be our 4th after the point. Now, the smallest price movement in this here would represent our pip. So if this price was to move from 1.1051 to 1.1052, then price would have increased by 1 pip. The 4th decimal place would have changed from 1 to 2. However, we do have a few exceptions to this. So for example, in our JPY pairs, where the pip is at the 2nd decimal place. So you realize that pairs that are quoted against the Japanese dollars, instead of the pip being in the 4th decimal place, it is represented in the 2nd decimal place. So here we have 110.40, and we're seeing here on the right where it moved from 110.40 to 110.41. That would be a change in the pip because it is represented by the 2nd decimal place and not the 4th as other currency pairs. So this would have increased by 1 pip. Alright, so the next thing is these prices that we keep quoting, these prices that we keep talking about. Now there is 2 prices when you're trading Forex. You have the bid price and you also have the ask price. Bid price is the amount of money a buyer is willing to pay for a security. So if someone is looking to sell the security, they would receive the bid price. Whereas the ask price is the amount a seller is willing to sell a security for. And if someone is looking to buy the security, they would buy at the ask price, as this is the price someone is willing to sell the security at. The difference between these 2 prices, the bid and the ask price, is referred to as what we call the spread. Now, the spread is how market makers derive profits, and market makers are simple our brokers that we trade through. Thus, the higher the spread is, the greater the profits are for the market makers. So this is how brokers basically make their money. So when you execute a trade, the difference between these two prices is how the brokers derive their profits. They derive their profits through the spread. Alright, so here's an example here. So on the left hand side, we have our base currency. On the right hand side, we have our counter currency, or what we call our quote currency. Now on the left is our bid price, and on the right is our ask price. Right, so as previously stated, the difference between the bid price and the ask price would be our spread. Right, so the difference between our bid price and ask price would represent our spread, and this is how the brokers make their money. So the difference between 1.1053 and 1.1051 would be 2 pips. Therefore, if you were to enter the market, you would enter off by 2 pips. That would be basically the broker's fee. So you'd enter 2 movements of what you would enter the market at. Right? So when choosing a broker, you'd want to choose a broker with the lowest spreads possible. So lot size. Now, Forex is commonly traded in specific amounts called lots, or basically number of currency units you're willing to buy and sell. So we were talking about the prices. Now, when you are buying at these specific prices, you want to buy a certain amount of these currency units. So for example, you want to buy 10,000 of the euro dollars, you want to sell 10,000 of euro dollars, you want to buy 100,000. The more you buy, basically, is the more money you will make. So if you place a buy on the euro USD, you need to know how much units of this currency will I purchase. Will I buy 10,000 euro dollars against USD? Will I sell 10,000 euro dollars against USD? Right? So the greater your lot size is, the more opportunity for profit. Because think about it. If you buy 100,000 worth of something, it appreciates in value, then you have more to sell back at a higher price, so you'd make more money. Consequently, if you have lower amount, if you just buy 2 units of euro dollars and price appreciates, you sell it back, you would still make profit. However, you'd make profit at a lower rate than someone who bought a lot of the currency units. Now, lot sizes are normally quoted in 3 main lots. So you have a standard lot, which is 100,000 of the currency unit. You have a mini lot, which is equivalent to 10,000 of the currency unit. And you have a micro lot, which is equal to 1,000 of the currency units. A question you might ask yourself: how am I going to buy so much of this currency unit? I mean, I just have like 100 US dollars. How am I going to buy so much amount of this? How am I going to be able to afford to buy 100,000 of a currency unit? Well, this is where the term leverage comes into play. Now, leverage is the use of borrowed money to invest in a currency, stock, or security. Right? So if an investor buy 100,000 worth of the euro US dollars, they might be required to hold 1,000 in the account as margin. So when you're trading through a broker, you're basically trading on a margin. Hence, that gives you an edge to purchase more than what you have in your account. So in other words, the margin requirement in this example would be 1% here. So trading on margin gives you the opportunity to purchase a lot of the currency units without having the money, as you're trading on margin. Alright, so let's sum up everything that we have learned in this video, because I know it's a lot to take in. I'm going to cover everything that we have learned in this video with a scenario. So for example, an investor might buy 10,000 units of the USD. Now that's lot size. Remember, we purchase or we sell the currencies in what we call lot sizes. So in this example, we buy 10,000 of the euro USD at an ask price of $1.10. Ask price is the price someone is willing to sell the security at. So you buy at the ask price because that's the price someone is willing to sell you the security at, with the hope that the exchange rate will rise. Assuming the rate move favorably, the trader would unwind the position for a few hours later by selling the same amount of euro USD back to the broker using the bid price. The difference in price movement between the buy and sell exchange rates will represent the gain or loss on the trade, which is our pips. So if you buy at a specific price, the price rises, then the difference between those two prices would be our pips, which is our percentage in point or price that has moved. So this takes us to the end of our part 1 series of our ultimate beginner's guide to Forex. So definitely more videos will be coming on the basics of Forex, so don't forget to subscribe the video for more content like this, and I'll see you in the next beginner's guide.